Morning, everyone. We're going to be looking at assignment 2. And looking at assignment 2, for question 1, they give us that information. Regarding the ordinary shares, the preference shares, and the long-term debt. And then they say, for question 1.1, calculate the cost of retained earnings, new ordinary shares, preference shares, and long-term debt for the company, and indicate the maximum investment that the company makes in new project before it must issue new ordinary shares, which is the breakpoint of ordinary shares as well. So to answer this question, we are going to say, we are going to refer to the formula for calculating the cost. So the first cost that we're going to be looking at is the cost of retained earnings. So we're going to look at the cost of retained earnings. Now, for the cost of retained earnings, the formula is that the cost of retained earnings is given as D1 over the price of the share plus growth rate. So this gives us the cost of retained earnings, where D1 is given as D0 in brackets 1 plus growth rate. So you need to be able to check to see from the information that is given, are we given D0 or are we given D1, right? So if you check on the information that were given on the question, they tell us that the company paid a dividend of $2.35 on each of the 900 ordinary shares. So whenever they are referring to something that has just happened, like for example, if they say the company just paid the recent or the current, then you know they're talking about what? D0. So those are the wording and the phrases that you have to look out for. That gives you a guideline on whether they are giving you D0 or D1. But if they say whenever they are referring to a dividend in the coming period, like for example, if they say coming, they say next, or they say if they say the coming period, the dividend in the coming period, the dividend in the next period, or whenever they refer to the period just preceding, they're just going to be after the period that we're currently in, then you know that they're talking about what? D1 as well. So you must always make sure that whenever you're given a question like this one in the exam, take note, and you should be able to distinguish between D1 and D0 and look for these keywords and phrases that allows you to be able to make that distinction as well. So now that we're given that information, if we check, so we are on the question, they tell us that if we check on the question, they tell us that the company paid a dividend of $2.35. So that's our D0. And then they say the market price of the ordinary shares is 55. That's our P0. And then they tell us the growth rate as well, right? Then when they talk about the underpricing inflation cost, that's when you're issuing new shares as well. So which means we already have all the information that we need for us to be able to calculate what? The cost of retained earnings. So which means in this case, the cost of retained earnings is given as, so the cost of retained earnings would be given as your D0 of 2.35 in brackets 1 plus growth rate, and the growth rate in this case it's given as 8%. So that they give us a growth rate of 8%. So it's going to be 1 plus 0.08 in bracket divided by the current price of the share, which is 55, plus the growth rate as a decimal, 0.08. So whenever they give you the growth rate or the cost of the required rate of return in a formula, you always have to put them as what? As decimals. So in this case, if you do the calculation, how much do you get as the cost of retained earnings? If you do the calculation, how much would you get as the cost of retained earnings?
It's 12.61%.
So whatever amount you're going to get here, you're going to multiply that by 100 and you should get 12.61%. Are we on the same page? Any questions? Anyone lost? Now, when it comes to the cost of the next cost that we're going to be looking at is they also ask us to calculate the cost of new ordinary shares. So we're going to look at the cost of new ordinary shares. Now, looking at the cost of new ordinary shares, we are given that the ordinary shares, the underpricing and flotation cost amount to 12 Rand when the company issues new shares. So which means in this case, for the cost of new ordinary shares, we're going to say the cost of new shares is given as D1 over the price minus flotation cost minus any discount plus growth rate. So from the price that is given, we're going to subtract any flotation costs and any discounts if they are going to be given as well. So what they did in this question is that the flotation costs and the discount, they basically sum them up together. And then they say the underpricing and the flotation costs amount to 12 Rand. So in this case, it would mean your cost of new ordinary shares is going to be 2.35 in brackets 1 plus 0.08 divided by the price of the share, which is 55, minus 12 plus 0.08. And this will give us the cost of new ordinary shares. And you should be able to get a figure of 13.9%. Are we together? Any questions? Anyone lost? Any questions? Can we move on? Next, we look at the cost of preference shares. So we're going to look at the cost of preference shares as well. Now, the cost of preference shares is given as the dividend of the preference shares divided by the price of the preference shares. So if the dividend of the preference shares divided by the price of the preference shares. Now, from the price of the preference shares, they can also be issued and incur flotation costs. So the preference shares can also be issued also and also what? Incur flotation costs as well. So which means the cost of the preference shares will be given as your dividends for the preference shares divided by the price of the preference shares minus any discounts or flotation costs incurred when issuing the preference shares as well. So if you check on the information that we're given, they tell us that the company can issue 3 Rand dividends, a dividend and preference shares at a market price of 23 Rand per share, and the flotation cost will be 150 per share as well. So the information is already given to us. There's nothing, it's just a matter of what putting on the information in the formula. So it's 3 over the price of the preference shares, which is 23, minus any flotation cost of 150. And then we multiply that by 100. And if you do the calculation there, you must be able to get 13.95%. Are we getting the same amounts? Then the next capital component that we're going to be looking at is the cost of long-term debt. So we're also going to look at the cost of long-term debt. Now, when it comes to the long-term debts, if you check on the question, they tell us that for the long-term debt, it's going to be £1,000 value, 10% coupon, 5-year bonds that can be sold for 1,200 will be issued with a flotation cost of 25 Rand per bond. So the company is in the 28% tax bracket as well. So that's basically what they give us there as well, right? So which means the interest per year that you're going to calculate on this particular bond is also the cost of debt. So the cost of debt is the interest per year that you're going to calculate from the given information. So which means in this case, we're going to say we're given that the par value of the bond is 1,000, and we also know that the PMT on the bond is given as the coupon rate times the par value divided by the number of times the compounding per year. So this gives us the PMT on a particular bond. So they say the coupon rate is 10%, and we know that the par value is equals to 1,000, and the bonds, if they don't say anything about the compounding frequency, you assume that what? Yeah, it's compounded annually, right? If they don't say anything for Fin3701, you assume that the bond is being compounded what? Annually. So which means in this case, you're going to say is equal to 0.1, which is the 10% coupon rate, times 1,000. And remember, any number divided by 1, because you're compounding once a year, gives you that number. So we don't need to adjust there. Then they also tell us that it's a 5-year bond, and we know that your N is given as T multiplied by M, where T is the number of years and M is the compounding frequency per year. So which means if you're compounding once a year, you don't have to account for that as well, which means that your N is going to be equal to 5. Then from here, they also tell us that the bond is going to be sold at a price of 1,200 and going to incur flotation cost of what? 25 Rand, which means the present value on this particular bond is going to be the price of the bond minus any flotation costs minus any discount. So this basically gives you, it's basically the par value. So it's going to be the par value of the bond. Okay, the price of the bond, because they've already done the calculation for us. So it's going to be the price of the bond minus any flotation costs minus any discounts, because they've already made adjustments to the price of the bond as well. So which means that the price of the bond in this case is equal to is given as 1,200. Then they tell us that we're going to incur flotation costs of 25 Rand. So it's going to be minus 25. So it's going to be the price of the bond of 1,200 minus the flotation cost of 25 Rand. And they don't mention anything to do with discount, because remember, in this case, the bond is being issued at what? At a premium. So which means, so this gives us the present value of the bond. So the interest per year that we're going to calculate in this case is the before tax cost of debt. So the interest per year that we're going to calculate in this case is the before tax cost of debt. So in this case, how much is the before tax cost of debt? If you do the calculation in this case, how much do you get as the before tax cost of debt? Can you please do the calculation?
It's 5.86%.
So you get 5.86%. Please note as well that when you're doing this calculation, remember you're given the future value, you're given the PMT, you're given the present value, right? So which means when you look at the cash flows of a particular bond, if you're from the investor's perspective, you are spending this much today, and then you're expecting these coupon payments as inflows, and you're expecting the par value as an inflow as well. So what do you see? When it comes to the signs of your cash flows, when you do the calculation here, make this present value negative. Otherwise, if you don't make the present value negative, what is going to happen? You will either get an error message on your calculator, or and no solution message on your calculator. The moment you get that solution, that message on your calculator whenever you're doing time value of money, there is no other logical explanation except what you're forgetting this relationship. Are we on the same page? Any questions? Anyone lost? Now, the other part of the question that they give us, that they were asking us to find, is the breakpoint of ordinary shares, right? So the breakpoint of ordinary shares is given as the amount of resources from the financial source divided by the weight of the financial source. So the amount of resources from the financial source divided by the weight of the financial source. So the amount of resource, when it comes to the breakpoint of ordinary shares, the amount of resources from the financial source will be the amount that we are having available currently from retained earnings. And from retained earnings, we have 3.8 million available that we can utilize from what? From retained earnings. And then we are also told that ordinary shares have a weight of 55%, preference shares have a weight of 15%, and long-term debt has a weight of what? 30%. So it's going to be divided by 0.55. So given this information, what would be the breakpoint of ordinary shares? You must be able to get a figure of 6,909,091. So your breakpoint of ordinary shares would be an amount of financing of 6,909,091. Are we on the same page? Please note, there's something I missed out here. Remember, we got the before tax cost of debt here, isn't it? We got the before tax cost of debt being 5.86%. Normally, what you should do is that when you're given the before tax cost of debt, because eventually you want to be able to calculate the weighted average cost of capital, right? When you are able to deduce whenever you deduce the before tax cost of debt, ideally, you need to now be able to also calculate the after-tax cost of debt as well. Now that you have the before-tax cost of debt, you should be able to calculate the after-tax cost of debt as well. So which means when you do the calculation here to get the before-tax cost of debt, you need to calculate the after-tax cost of debt as well. So your after-tax cost of debt is given as your before-tax cost multiplied by 1 minus tax rate, which means your before tax cost of 5.86% in brackets 1 minus. If you check on the question, the tax bracket that we belong to in this case is what? 28% tax bracket, so it's 0.28. So this will give us the after-tax cost of debt. And if you do the calculation there, you must be able to get a figure of 4.22%. You must be able to get a figure of 4.22%. please try to do these calculations with me so that I'm also using you as verification of what I've done as well. So that I'm not just going to be repeating the same mistakes that I would have done if I made a mistake. Just in case I made a mistake, I won't be repeating that mistake. We'll be able to what? Highlight those mistakes as well, in case there's any mistake as well. So please try follow me when we're doing these calculations so that you see if there's going to be any mistake. That's the reason why we're having this class, so that we also address them as well. So are we on the same page when it comes to question 1.1? Any questions? Anyone lost? So can we move on to question 1.2?
Yes.
All right. For question 1.2, they ask us to calculate the weighted average cost of capital below and at the breakpoint of ordinary shares. So they ask us to calculate the weighted average cost of capital below or at the breakpoint of ordinary shares. Then 1.3, they ask us to calculate the weighted average cost of capital above the breakpoint of what? Of ordinary shares. So that's question 1.2 and 1.3. So we're going to be calculating this weighted average cost of capital based on the information that we've calculated here. So for question 1.3, 1.2, the weighted average cost of capital is given as the cost of debt multiplied by the weight of debt plus the cost of equity multiplied by the weight of equity. In this case, we're ignoring preference shares because we're not financing with preference shares. If we were financing with preference shares, let me just highlight that formula. It would mean it would be the cost of preference shares times the weight of preference shares plus the cost of equity times the weight of equity. But since we are not financing with preference shares, this part we are leaving it out. We're leaving it out. So when we are calculating the weighted average cost of capital at or below the breakpoint of equity, that's when we're going to be utilizing what? The retained earnings. So at the breakpoint of equity or below the breakpoint of equity, we are of ordinary shares. We are going to be utilizing what? Retained earnings to finance the different financing obligations there as well. So which means in this case, the weighted average cost of capital will be equal to our cost of debt, which is what we have calculated previously, as after-tax cost of debt of 4.22%, multiplied by, sorry, we're utilizing preference shares, isn't it? We are going to be utilizing preference shares, so this is going to be relevant. We're utilizing preference shares, so I'm confusing with the postgrad class that I did yesterday. So we're utilizing preference shares, so we're going to be saying cost of preference shares multiplied by the weight of preference shares plus cost of equity multiplied by the weight of equity. Because remember, we're utilizing preference shares in this case. So the cost of debt, the after-tax cost of debt is 4.22% multiplied by the weight of debt. If you check on the question, they tell us that the long-term debt is going to be having a weight of what? 30%. So as a decimal, the weight of debt is 0.3 plus preference shares. We calculated the cost of preference shares and we got it to be 13.95%. So it's 13.95 multiplied by the weight of preference shares. If you check on the information that we're given, preference shares were carrying a weight of 15%, so it's 0.15 plus the cost of equity. Remember we said before or at the breakpoint of equity, the cost there is what? The cost of what? Retained earnings. And we saw that the cost of retained earnings in this case was equal to 12.61 multiplied by the weight of equity, where we say ordinary shares are going to be having a weight of what? 0.55. So this will give us the weighted average cost of capital. And how much would you get as the weighted average cost of capital?
$10.29.
10.29%. So you get a figure of 10.29%. Are we on the same page? Any questions? Anyone lost? So we can move on. For question 1.3, our weighted average cost of capital is going to be equal to, now when we're calculating the weighted average cost of capital above the breakpoint of equity or of ordinary shares, it means that instead of utilizing the retained earnings, we're now going to be utilizing what? We've now exhausted the retained earnings amount available. So if we need more contribution coming from ordinary shares, we're going to be utilizing what? The issue of new ordinary shares at a different cost. So which means in this case, it becomes 4.22 multiplied by 0.3 plus 13.95 multiplied by 0.15 plus, now that we're going to be utilizing issue of new ordinary shares, it would mean our cost of ordinary shares is going to be 13.9%. So it's now going to be 13.9% multiplied by 0.55. So this will give us the weighted average cost of capital above the breakpoint of ordinary shares.
I get 11%.
So you must be able to get a figure of 11%. So you must be able to get a figure of 11%. Are we together? Any questions? Anyone lost? So we can move on to question 2. Now for question 2, they give us that information. So they tell us that they're considering investing in that investment, which is expected to generate those cash flows. Now, from the financing sources, they are expecting to utilize 40% from debt and 60% from equity. And they give us the information about the price of the ordinary shares, our D1, and the growth rate as well. And then they say the before tax cost of debt is 9%, and we're in the 28% marginal tax rate. Then from there, they tell us that for question 2.1, they ask us to calculate the weighted average cost of capital associated with the investment. So for this investment, we're financing with the debt and equity. We are not utilizing what? Preference shares. And from here, we are not given the cost of the after-tax cost of debt is not given. The after-tax cost of equity is also not given as well. So for us to be able to calculate the weighted average cost of capital, we're going to say for question 2.1, our weighted average cost of capital is given as the after-tax cost of debt multiplied by the weight of debt plus the cost of equity multiplied by the weight of equity. So from here, we are given that for the cost of debt, the after-tax cost of debt is given as, so the after-tax cost of debt is given as the before tax cost multiplied by 1 minus tax rate. So which means in this case is going to be equal to an amount of before tax cost of 9% multiplied by 1 minus the tax rate of 0.28. So this will give us the after-tax cost of debt. And you must be able to get a figure of 6.48. Are we getting the same amounts? We also look at the cost of equity. And for the cost of equity, we are given that we're given the price, and then they mention the growth rate, and they are only mentioning one growth rate. If they mention one growth rate, it means we are using the dividend growth model, which is based on the what? Constant growth. So if they mention one growth rate there on your question, automatically it means we are utilizing what? The dividend dividend growth model, and we're utilizing the what? The constant growth model is in this case. And for the constant growth model, we know that the cost of equity is given as, so we know that the cost of equity is given as your D1 over the price of the share plus the growth rate, which means in this case is going to be equal to our D1 of 2 rand divided by the price of the share, which is given as 33, plus the growth rate, which is given to us as 5%. So this will give us the cost of equity. Are you getting 11.06%? So you must be able to get a cost of equity, which is 11.06%. So what do we see? To calculate the weighted average cost of capital, we have now managed to get the after-tax cost of debt, the cost of equity. We are already given the weights. So we can calculate the weighted average cost of capital in this case. So for the weighted average cost of capital, it would mean our weighted average cost of capital is equal to our cost of debt, which is 6.48%, multiplied by the weight of debt, where we say debt is going to be carrying a weight of 40%, which is 0.4 as a decimal. The cost of equity is 11.06 multiplied by the weight of equity, which is 60%, so it's 0.6. So this will give us the weighted average cost of capital. And how much do we get?
$9.23.
9.23%. All right. On the next part of the question, for question 2.2, also looking at 2.3 as well. For question 2.2, they ask us to calculate the net present value, the internal rate of return, and the payback period for the investment if the initial cost is 100,000. So if the initial cost is 100,000, they ask us to use the capital budgeting techniques to do those calculations as well. To calculate the net present value, you need to indicate your steps using the steps that you're utilizing using the different financial calculators that you're going to be utilizing in this case. So you need to indicate the steps that you're using the different financial calculators. And if you are going to be using so I'll show you the step using the HP calculator and also the Sharp calculator as well. Now, utilizing the HP calculator, it would mean, if you remember, they're telling us that you're spending 100,000, then you're expecting those cash flows of 60,000, 36,000, 30,000, and 24,000. That is given on the first sentence of the question there, right? So which means now, given this information, we're now going to say 100,000, make it plus minus to indicate that this is the cash outflow, and you press CFJ. Then from there, you are going to indicate the cash inflows now, which is 60,000 CFJ, 36,000 CFJ, 30,000 CFJ, and 24,000 CFJ. So you have now entered the cash flows from period 0 all the way to year 4. Please note, whenever we are entering cash flows to get the net present value of the cash flows, you always start with cash flow for period 0. If it's not given, you put 0. If it's given, you indicate what the cash flow is. Many people, they skip that cash flow, and if they skip acknowledging that cash flow, the calculator will think that whatever cash flow you're putting for year 1 is actually for year 0, which means the timing of the cash flows becomes wrong and your answer becomes wrong as well. Then from here, remember we did the calculation before where we saw that the discount rate is going to be based on the weighted cost of capital. And the weighted cost of capital that we saw was 9.23. So we're going to say 9.23 is your interest per year. Then shift Then you calculate the net present value. Then if you're going to be utilizing the sharp calculator, you're going to say 100,000, make it negative, to indicate that it's a cash outflow, and then you press enter. Then 60,000, you press enter. 36,000, you press enter. 30,000, you press enter. 24,000, enter. Then from there you say second function, CFI, then it asks you for the discount for the rate per year, and your rate per year is 9.23, so it's 9.23. You press enter. Then from there you scroll down and then you compute. So given this information, the net present value is going to be equal to how much? If you do the calculation, how much do you get as the net present value? How much do you get as the net present value?
It's 24,981.91.
24,981.91. Are there any questions regarding how we got the net present value? Are there any questions? Anyone lost? All right. Now, they also ask us to calculate the internal rate of return, right? Now, to calculate the internal rate of return, you don't have to repeat the same steps that you've done because the cash flows are already entered for you already, right? You've already entered the cash flows already when you're calculating the net present value. So you won't need to repeat the same steps when calculating what? The internal rate of return. So if you're using the sharp calculator to calculate the internal rate of return, all you need to do is press the red button. Then you say second function, you press CFI, then you compute. If you're using the HP calculator, all you have to do is press Shift, and then you press the IRR button. So you press Shift, and then you press the IRR button, right? And this will give you the internal rate of return. And how much do you get as the internal rate of return? So how much would you get as the internal rate of return?
It's 22.47%.
22.47%. Okay. Someone posted, is it Trish? You're having issues with your calculator. It's in stats mode, huh? The easiest thing to do there, if you have your pen with you, check at the back of your calculator. Just press the reset button. Everything resets as well. Because I know that you have to press mode. I can't remember exactly. After pressing mode, which option to take. I think it's mode 1 or something like that, where you're going back to normal mode.
Oh, okay. No, thank you. I've been struggling.
So the easiest way to do it is just to reset. You press, if you open your calculator at the back there on the behind the cover, you just press the reset button. Then if not, then you can just go to mode. I think it's mode 1, just to go back to normal calculations there.
Okay, thank you. Thank you so much.
All right. So we're getting 22.47%, right? Okay. Now, we have now calculated the net present value and the internal rate of return. So from here, we also need to calculate the payback period, right? So the payback period in this case is a bit complicated, mainly because we are having or dealing with a mixed stream of cash flow. So we need to account for them one by one, since we're dealing with what? Mixed stream of cash flows. So to get the payback period, for the payback period, we're going to say our cash flow for year 0 is an outflow of 100,000. Then our cash flow at the end of year 1 is an inflow of 60,000. So if we have an inflow of 60,000, we are still left with what? 40,000 that we need to recover. Then our cash flow for year 2, we're going to recover 36,000, which means we are still going to be left with another 4,000 that we need to recover. Then in year 3, our cash flow is 30,000. So it means somewhere during year 3, that's when we recovered fully the amount that was that we invested. So that's when the investment paid us back our money, isn't it? So we need to find out exactly. So how long did it take? What part of the year did it take for us to recover the money? So you're going to say the part of the year that it took to recover the money is given as what you needed was 4,000 and you generated 30,000 multiplied by. Now, if they want you to put this answer in years, you multiply that by 1 year. So you're just going to multiply that by 1 year. If they want you to put this answer or this part of the remaining periods in what? In months, you're going to multiply this by 12. If they want you to get the remaining period in weeks, you're going to multiply this by 52. If they want you to get this remaining period in days, you're going to multiply that by what? 365 days in a year. So that's how you're able to get what? The part of the year that is outstanding. So in this case, it's going to be 4,000 over 30,000 multiplied by 1 to see exactly what part of the year did it take for us to recover the money that we invested. And you get 0.13 years. So which means it took us 1 full year, 2 full years, and 0.13 years to recover our money. So which means in this case, the payback period is equals to 2 years plus 0.13 years, which is equals to 2.13 years. So that's our payback period. So our payback period is equals to 2.13 years. Are we together? Any questions? Anyone lost? Now for question 2.3, they say state on the basis of the net present value, IRR, and payback period, whether the company should go ahead with the investment, right? So what do we see? Based on the net present value, what do we see? Our net present value is greater than 0. So which means the investment is acceptable. Our IRR is more than our cost of capital of 9.23%, which means the investment is acceptable. Our payback period of 2.13 years is less than the maximum acceptable period of 3 years. Remember, they say the investments accept investment with a payback period of not more than 3 years. So our payback period was less than 3 years, which means the investment is what? Acceptable. So based on the net present value, the IRR, and the payback period, overall, we can conclude that what? The investment is acceptable. Are there any questions? Any questions? Anyone lost? So we can move on to the next question. All right. Moving on to question 3. Question 3, they give us that information. So for question, they give us that information. And for question 3.1, they say, calculate the business operating break-even point and the earnings before interest and tax on the departmental store order as well, right? So on that order, we are asked to find the operating break-even point and also the earnings before interest and tax of the order as well, right? So we need to find the operating break-even point of the business and also the earnings before interest and tax of the order, right? So the operating break-even point is given as the total fixed costs divided by the selling price per unit minus variable cost per unit. So this will give us the operating break-even point. So your operating break-even point is given as your total fixed costs divided by your selling price per unit minus your variable cost per unit as well. So from the given information of the question, they tell us that we are told that our fixed cost in this case comes in the form of rent of 4,000, and the selling price per unit is given as 8 rand, and the variable cost per unit is given as 6 rand per unit. So which means the operating break-even point is going to be 4,000 divided by 8 minus 6. So this will give us the operating break-even point. And how much do we get?
It's 2,000.
So we get a figure of 2,000 because it's going to be 4,000 divided by 2, which is what? 2,000 units. Then for 3.2, they tell us that for question 3.2, before we go there, we also need to find the earnings before interest and tax on the Department of Store as well, right? So we also need to get the earnings before interest and tax on the Department of Store for the order, specifically for the order. So to get the earnings before interest and tax, we say our sales minus variable costs minus fixed costs, and this will give us the earnings before interest and tax. So this will give us the earnings before interest and tax. Now, from the given information, for the order, remember they tell us that the contract is to produce 1,500 figurines, and the proposal by the buyer is that they are willing to buy these figurines at a price of so they're willing to buy these figurines for a total amount of 10,000. So they're not buying per unit, they're buying for a total amount of what? 10,000. So they're offering a total of 10,000 for the figurines. So we need to find out exactly what is going to be the earnings before interest and tax, since they are proposing to buy what? 1,500 figurines as well. So which means in this case, your variable cost is going to be equal to, we know that the variable cost per unit is 6 rand, and we're buying 1,500 figurines. So how much do we get as the total variable cost?
$9,000.
So our variable costs are going to be equal to a total of 9,000. And we already know that our fixed cost in the form of rent is 4,000. So how much would be our earnings before interest and tax? $13 minus 10, we have a loss of 3,000. So it's a loss of 3,000. Are we together? For question 3.2, they tell us that if John renegotiated the contracts at a price of 10 rand per figurine, what will be what will the earnings before interest and tax be, right? So if they renegotiate the contract at a price of 10 rand per figurine, what will be the earnings before interest and tax? So which means in this case, we're going to say our sales is going to be equals to 10 rand per figurine, and we're going to be selling 1,500 figurines. So we need to find out exactly how much our sales is. Our variable cost is 6 rand multiplied by 1,500 figurines, and our also is minus fixed costs, minus variable cost, minus fixed cost as well. The fixed cost is already given to us as an amount of 4,000. Remember here, we saw that the variable cost amount to 9,000. So how much does the sales amount to? How much does the sales revenue amount to?
$15,000.
15,000. So if it's now 15,000, how much do we get as our earnings before interest and tax?
$2,000.
2,000. So it means it results in a profit of 2,000. Are we together? Any questions? Anyone lost? Question 3.3, they tell us that if the buyer pays 8 rand per unit, but is willing to negotiate quantity, what quantity of figurines will result in an earnings before interest and tax of 4,000? So we need to find out exactly what quantity of figurines would result in an earnings before interest and tax of 4,000. So for question 3.3, to get the quantity that enables you to generate a certain profit, you are going to say the quantity is given as your fixed costs plus target profit divided by selling price per unit minus variable cost per unit. So your fixed costs plus your target profit divided by your selling price per unit minus your variable cost per unit. This will tell you exactly how much quantity enables you to generate what? A certain profit. So from the given information, our fixed cost, we already know it, it's 4,000. Our target profit is given to us as 4,000. Our selling price per unit, remember they tell us that in this case, the buyer negotiates to buy at 8 rand. And we know that our variable cost per unit is always going to be 6 rand. So what quantity enables us to generate that profit? So what quantity enables us to generate that target profit?
It's 4,000 units.
4,000 units. Any questions? Anyone lost? So we can move on to question 4. Looking at question 4, they give us that information. So they give us that information. And for question 4.1, they ask us to calculate the annual interest expense deductible for tax purposes for each of the 5 years. So if you check on the information that they give us there, you will see that they give us the loan payments, and they give us that this loan is going to be over 5 years, and they tell us that the interest is going to be 15%, right? So they give us the loan payments. They say the loan is going to be over 5 years, and the interest is 15%. And then they also give us the amount for which we're going to be able to purchase this investment for. So in the previous assignments, I remember I gave, we did it using the financial calculator, but it seems like the lecturer wanted us to deduce it manually to get the information as well manually, right? And show working as well. So what we're going to do is that I'll show you exactly how you're able to deduce the interest payments from the given information as well. So to get the interest payments, we're going to say the interest payment in a year is a percentage of the opening balance that is outstanding. So from the opening balance for a particular period, that's how we're able to get the interest is always going to be a percentage of the what? Of the opening balance for that particular period. So which means whatever is the outstanding balance at the beginning of that period, the interest is always going to be what? A percentage amount of that outstanding balance. So which means in this case, to get the interest for year 1, we're going to say the interest for year 1 is given as the opening balance multiplied by the interest rate. So it's the opening balance multiplied by the interest rate. So which means in this case for year 1 is going to be the opening balance is 20,000. The interest rate is 0.15. And how much do we get as the interest? How much is the interest?
3,000.
You must be able to get an interest amount of 3,000. Then, now we need to find out exactly, so what is the closing balance for year one, which becomes the opening balance for year two as well, right? For us to be able to get the closing balance, we need to first find out exactly how much is the principal repaid. And the principal repaid is given as the loan payments minus the interest paid. So the loan payments minus the interest paid gives you the principal repaid for that particular period. Mainly because for every loan payment that you make, it's actually split into two. Some of it is going to be charged as interest to the bank, and some of it is going to be charged going towards repaying the amount outstanding. So which means in this case, your principal repaid is going to be equal to your loan payment. We know that in each year we're making loan payments of 5,967, and in the first year we paid interest of 3,000. So this will tell us exactly how much the principal repaid was for year one and how much do you get. Are you getting 2,967?
Yes.
Now, if this is how much we paid towards the outstanding balance, it means the closing balance for the year for the loan is given as the opening balance minus the principal repaid. So this means is equal to your opening balance was 20,000. You repaid 2,967. So in this case, how much is the closing balance for year one?
Um, 17,033 rand.
17,033. Are we on the same page? Any questions? Anyone lost? So we can now do the calculation for year two as well, right? So your interest for year two is equal to the closing balance for year one becomes your opening balance for year two, which is 17,033 multiplied by your interest rate of 0.15. So how much do we get as the interest for year two? How much do you get?
2554.95.
Which is 2,555. Then your principal repaid is equal to the loan payments of 5,967 minus the interest payment of 2,555. So this will tell us exactly how much principal was repaid in year two.
3,412.
3,412. So it would be 3,412. Then the closing balance for year 2 will be equal to your opening balance. You started off owing 17,033. You repaid 3,412. So how much is going to be the closing balance for year 2?
$13,621.
13,621. So we can now move on to year 3. Your interest for year 3 is given as your closing balance for year 2 becomes your opening balance for year 3. So it's 13,621 multiplied by the interest rate of 0.15. And how much is the interest for year 3?
$2,043.
2,043. And your principal repaid in year 3 is equal to your loan payment of 5,967 minus interest payment of 2,043. And how much is your principal repaid for year 3?
$3,924.
So it will be 3,924. And then the closing balance for year 3 would be equal to the opening balance of 13,621 minus principal repaid of 3,924. And how much is going to be the closing balance for year 3?
$9,697.
9,697. Then your interest for year 4 is equal to the closing balance for year 3 becomes opening balance for year 4 of 9,697 times 0.15. And how much is the interest for year 4? How much do you get?
$1,455.
1,455. Then your principal repaid is equal to 5,967 1,467 minus 1,455. And how much is the principal repaid?
For 512.
4,512. Then the closing balance for year 4 would be equal to the opening balance of 9,697 minus 4,512. You get a figure of 5,185. Then your interest for year 5 will be equal to the opening balance of 5,185 multiplied by 0.15. And you should be able to get a figure of 778. So that's your interest for year 5. The others, you can do the calculations for them, but remember the question was asking us to deduce the interest. So this is the interest for year 1, the interest for year 2 that we need, for year 3, for year 4, and for year 5. So these are the interest amounts that we need. Are we on the same page? The next part of the question, we were asked to deduce or calculate the after-tax cash outflow resulting from the purchase of each of the for each of the 5 years. So we need to calculate the after-tax cash outflow, right, from the purchase option. So to calculate the after-tax cash outflows, we are going to say the depreciation, we need to calculate the depreciation, where the depreciation is based on a straight line method. So if you check on the question, they tell us that the machine will be depreciated over a 5-year period, and the cost of the machine is what? 20,000. So if it's going to be depreciated over a 5-year period, we're assuming a straight line method here, which means it's going to be 20,000 over 5. So which means the depreciation per year will be equal to 4,000. Now from there, we are going to say we have the year, and we are going to indicate the loan payments And we also indicate the service and maintenance costs. And we indicate the depreciation. And then we indicate the interest expense. And then we indicate the total deductions. Then from the total deductions, we should be able to find the tax shield. And then after determining the tax shield, we can now calculate the after-tax cash outflows. Now, for each year, we see that the loan payment is the same, which is given as 5,967. And the service and maintenance costs are given as 1,000 each year. The depreciation expense, we got it to be 4,000. Now, from the previous calculation, we were able to deduce the interest expense, where we saw that in the first year, the interest expense was 3,000. In the second year, the interest expense was 2,555. And then it was 2,043. Then it became 1,455. And then lastly, it was 778. For our total deductions, our service and maintenance costs plus depreciation expense plus interest expense gives us the total deductions. So how much do we get for the first year? How much is our total deductions for the first year?
$8,000.
It's supposed to be 8,000. Please correct on the memo that I'm going to correct on the memo that I gave you there. I added a figure which is not supposed to be added. We're not supposed to include loan payments because loan payments already include interest expense. So it's supposed to be your service and maintenance cost plus depreciation plus interest expense as well. So this gives us an amount of 8,000, right? Now, from the 8,000 figure, your tax shield is going to be equal to 28% of, remember they tell us that the tax shield is going to be based on 28%, isn't it, right? So your tax shield is going to be 28% of your total deductions. So how much is your tax shield?
$2,240.
So our tax shield is 2,240. So our tax shield is going to be 2,240. Now from there, we need to calculate the after-tax cash outflows, right? So to get the after-tax cash outflows, we say the loan payments plus the service and maintenance costs minus the tax shield. So this will give us the after-tax cash outflows. We don't include depreciation because it's a non-cash item. And we don't include interest expense because it's already what included as part of the loan payments as well. So that's why we don't include these two. So which means now when you say your loan payments plus your service and maintenance cost minus your tax shield, how much is your after-tax cash outflow?
$4,727.
4727. So you get a figure of it's for
4,727.
okay. 1,000. Oh, yeah, 4,727. So that's for year one. We're going to do the same calculation for year two as well. So for year two, our total deductions would be equal to our service and maintenance cost, our depreciation expense, and our interest expense. So this will give us the total deductions. And how much is our total deductions?
It's 7,555.
So 7,555 multiplied by 28%. Are we getting the same amount? Are we getting the same amount?
Yes.
All right, then how much is the after-tax cash outflows? how much would we get as the after-tax cash outflows?
4,852.
So we get a figure of 4,852. Then moving on to step number 3, our total deductions would be equal to 7,043 and our tax shield will be 1,972 and our after-tax cash outflow would be 4,995. Are we getting the same amount?
Sorry, can I ask a question? How do we calculate the after-tax outflow again? I just want to make sure that I got it correct.
Our after-tax cash outflow will be your loan payments plus your service and maintenance costs minus your tax shield.
Okay.
So you subtract the tax shield.
All right. Thanks.
Remember, we're excluding depreciation because depreciation is a non-cash item, and we're excluding interest expense because it's already part of the what? Loan payment amount.
All right.
So we don't want to double count the amount. Can we move on? For year 4, our total deductions are 6,455. And our tax shield will be 1807. So our tax shield will be 1807, which means our after-tax cash outflow will be equal to 5,160. Are we getting the same amount? For year 5, our total deductions are 5,778. And our tax shield is 1,618. And this gives us an after-tax cash outflow of 5,349. Are we getting the same amounts? Any questions? Anyone lost? So these are the after-tax cash outflows that they were asking us to calculate. So remember the next part of the question, which is 4.2, which was what we're doing, they were asking us to find the after-tax cash outflows, right? Now for question 4.3, They are now asking us to calculate the present value of the cash outflows using a discount rate of 9% and determine which plan is preferable based on the listing versus purchasing present values as well, and give reasons for your choice, right? So to answer that part of the question, so it's either you're going to be using the sharp calculator or you're going to be using the HP calculator. Now, if you're using the sharp calculator, remember, you always have to acknowledge the cash flow for period 0. And in this case, there is no cash flows because these payments are being made at the end of each year. So you're going to say 0, you press enter. Then for year 1, you're going to say 4727, which is the after-tax cash outflow. Then you press enter. And for year 2 is 4852. And then you press enter. For year 3 is 4995. And then you press enter. For year 4 is 5160. And then you press enter. And then for year 5, it's 5349. And then you press enter. Then from there you say second function, CFI. Remember, they asked us to do this calculation based on the discount rate that they give us in this case, which is what? 9%. So you say 9, you press enter, you scroll down, and then you compute. And if you're going to be using the HP calculator, you're going to say 0. You always have to acknowledge the cash flow for year 0 all the time. And then CFJ, then 4727, CFJ, 4852, CFJ, 4995, CFJ, 5160, CFJ, 5349, CFJ. Then you say 9 is the interest per year, and then shift, and then you look for the net present value. So given this information, how much the net present value that you're going to calculate there is also the present value of cash outflows. And how much do you get? How much do you get?
$19,409.54.
So it'll be 400. Okay, I'll cross-check my answer. I got 19,325 0.37. You got how much? 19,409, is it?
Yeah.
Yes.
Yeah, it should be 19,409.54.
I got the same also.
Okay, so it will be 19,409.54. So what is preferable? Going the leasing route or going the borrow and purchase route? What is preferable? Going the leasing route or going the borrowing and purchasing route? Remember on the question they tell us that if we go the leasing route, the present value of the cash outflows is 13,316, right? And if we are to go to the purchasing and borrowing and borrow and purchase route, our present value of the cash outflows is what? 19,409.54, isn't it? So in this case, we are better off going the leasing route, isn't it? So we are better off going the leasing route, because if we go the leasing route, we're in present value terms, we're able to have a savings of 19,409.54 minus 13,316, which is a savings of an amount of 6,093.54. So it will result in a savings in present value terms of 6,093.54. So we are better off going the leasing route, because the leasing route has the lower present value of cash outflows, and therefore it will result in a savings of 6,093.54 in today's terms. Are we on the same page when it comes to the last part of the question? Any questions?